Hi there. This is the E.M.I for the month of November. So let's jump right in. In this month's E.M.I, as usual, we'd ask a few questions. Which institution is the largest contributor to India's Capex? How does India's household Capex look like? What can be seen as two key drivers of India's household construction Capex? And lastly, where does the support for India's Capex come from? There is always talk about public and private capex in market narratives. The big household capex often gets missed out. Let's talk about India's household capex. Last month, we put out a detailed report on India's public and private capex. This month, we focus exclusively on India's household capex. Household capex is a crucial component of India's capex, accounting for more than 40%. India's household capex contributes around 42% to India's total capex. India's investment intensity at 30% of GDP receives its highest contribution from household capex with a decadal average of 12% of GDP, followed only by private capex at 10%. A sector-wise breakup of this household capex for FY24, latest available data, shows a continued and range-bound skew towards services, predominantly real estate, followed by trade and agri capex. Services capex accounted for around 66% of total household capex in FY24, down from a peak of 74% seen during FY30. The key trend that stands out from this is the sharp drop in household real estate capex during the FY12 to FY16 phase. Take a careful look now at how the chart shows a drop during this phase. Now, real estate apart, incremental household capex over the last few years appear to be bunched around trade, hotels, and construction spending. What might this look like? This could probably have taken shape in the form of, let's say, small retail outlets, fixtures, furniture and fittings, home renovations, guest house upgrading, etc. 70% of household capex resides in dwellings and 30% in machinery and equipment. In the new series of GDP classification, capex can be broken down into four key assets: capex in dwellings, buildings, structures, machinery and equipment, plants and animals used for economic needs, known as biological resources, and intellectual property. More than 70% of household capex resides in dwellings, other buildings and structures that are probably like house construction, extensions, permanent fixtures, etc. The balance around 30% is in the form of machinery and equipment, which probably comes in the form of farm machinery, furniture, transport vehicles, etc. Now comes the interesting part. Let us zoom out a bit and look at the asset-wise breakup of capex across institutions, households, public and private. Households alone account for more than 50% of India's dwellings capex and nearly 40% in machinery and equipment capex. It is important to note here that Indian households have a negligible portion of investment in cultivated biological resources, which is plants and animals for economic purposes, and intellectual property. Why is all of this so important? Mainly because this perspective tells us how dependent India's capex is, especially construction capex, on the household's investment. Household construction capex is closely linked to residential sales and IT hirings. We analyzed household capex further. We backdated existing data using old capex categorizations. Instead of four assets, which is dwellings, machinery, biological resources, and intellectual property, we use two broad assets, construction and machinery, subsuming the other two in it. Construction accounts for nearly 60% of India's total capex, broken down nearly 50-50 into household capex and private and public capex. What stands out in all the charts so far is the appreciable drop in India's capex during the FY12 to FY16 phase, driven solely by a fall in household construction capex. Mapping household construction capex with the tier 1 and 2 residential property sales establishes the clear link it maintains with the residential property market. What made this exercise fascinating was the clear directionality household construction capex held with the headcount additions of top 8 IT companies. Domestic factors like disposable incomes, interest rates, affordability, inflation, among others, determine a household's intent to own residential property. However, we now also notice the strong external global orientation of household capex through the channel of IT hirings. Household savings finance nearly 60% of India's capex needs. 58% of India's capex needs are financed by household savings, followed by 34% from private corporations, 6% from public sector, and 2% external capital. This 58% is heavily skewed towards physical assets at 41%, followed by net financial assets of 16% and 1% savings of households as gold and silver ornaments. Apart from this large contribution of household saving to India's capex, the dominance of household physical saving in the form of dwellings becomes fairly clear. What also remains relevant for the household segment is the net financial savings part. Net financial savings of households have dropped by nearly 3% of GDP from pre-COVID to 5.2%, mainly on account of a 2.1% of GDP increase in household financial liabilities. Now, this is not a new trend and has been evident to markets for more than a couple of years now. Why are we talking about this then? Because this weakens the financing of India's capex. If the other sectors do not step up on the financing front, India's reliance on foreign capital would only have to increase to finance India's burgeoning capex needs. What can help alleviate this pressure in the near term is the main question. India would need a conducive global environment alongside employment-intensive public capex-driven growth that crowds in private capex. This then would deliver the well-needed reprieve for India.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.